Have you ever wondered why the rich seem to get richer while others struggle to even get started? It's not just about luck or having a high income. I used to think it was some big secret, but after years of studying the wealthy, I realized the biggest difference isn't in their bank accounts, it's in their minds. What if I told you that by changing how you think about money, you could start building real, lasting wealth today? Stay with me, because I'm about to break down the investing habits that separate the rich from the poor, and it's simpler than you think. Let's start by looking at the common investment traps that keep people from building wealth. First, many people invest emotionally. They see the market go up, feel the fear of missing out, and jump in at the peak. Then, when the market drops, panic sets in, and they sell at the bottom, locking in their losses. This emotional roller coaster is a wealth killer. The market doesn't care about your feelings. It operates on data and trends. Making decisions based on fear or greed is like trying to navigate a storm without a compass. Second, they chase trends. Remember when everyone was talking about a certain meme stock or a new crypto coin? Chasing hot trends without understanding the underlying value is pure speculation, not investing. By the time you hear about it on the news, the smart money has often already made its profit and is on its way out. The wealthy don't chase, they anticipate. They look for value where others aren't looking yet. Third is the lottery ticket mindset, the desire for overnight riches. People fall for get-rich-quick schemes because they want a shortcut. They invest in highly speculative ventures hoping for a 100x return in a week. True wealth isn't built overnight. It's built brick by brick, through consistent, disciplined investing over time. The pursuit of instant gratification often leads to instant disappointment. Another huge mistake is investing money they can't afford to lose. They might use their emergency fund or even take on debt to invest, hoping for a big win. This puts them in a fragile position. If the investment goes down, they're forced to sell at the worst possible time to cover their expenses. This is a recipe for financial disaster. Your investment capital should be money you can live without for at least 5 to 10 years. Next, they don't truly understand risk. They either think investing is like gambling and avoid it altogether, or they take on far too much risk without realizing it. They might put all their money into one single, volatile stock. They see the potential reward but are blind to the potential for total loss. Understanding risk means knowing that not all investments are equal and managing your exposure accordingly. Then there's the habit of spending first and investing what's left over. For most people, after bills, lifestyle expenses, and a few treats, what's left over? Usually, nothing. This approach makes investing an afterthought, something to do if there's money left. It guarantees you'll never invest consistently. Finally, they buy liabilities thinking they're assets. A fancy new car, the latest smartphone, expensive clothes, these are often seen as signs of success. But what do they do for your net worth? They depreciate. They take money out of your pocket. An asset is something that puts money asterisk into asterisk your pocket. Confusing the two is a fundamental error that keeps people on the financial treadmill. Now, let's flip the script and look at how the wealthy invest. It's a completely different world. First and foremost, they invest with a strategy. They don't just throw money at the market. They have clear goals, a defined time horizon, and a plan for how to get there. Their strategy dictates their actions, not their emotions. They know why they're buying a specific asset, how it fits into their portfolio, and when they might consider selling it. It's a calculated, business-like approach. Second, they focus on acquiring assets. This is the core of wealth building. Instead of buying things that lose value, they buy things that generate income or appreciate over time. This could be dividend-paying stocks, income-producing real estate, ownership in a business, or other assets that work for them. Their goal is to have their money make more money, creating a virtuous cycle of growth. Third, they think long-term. The wealthy aren't concerned with what the market does today or this week. They're thinking in terms of years, even decades. They understand that real wealth is built through the power of compound interest, and compounding needs time to work its magic. Short-term volatility is just noise to them. They're focused on the long-term trend, which, historically, is up. This long-term perspective allows them to ride out market downturns without panicking. Fourth, they diversify smartly. Now, diversification doesn't just mean buying a bunch of different stocks. It means owning different types of assets that behave differently in various economic conditions. They might own stocks, bonds, real estate, and maybe even alternative investments. This way, if one asset class is performing poorly, another might be doing well, smoothing out their overall returns and protecting their capital. It's about not putting all your eggs in one basket. Fifth, they reinvest their profits. When their assets generate dividends or capital gains, what do? They don't just cash out and spend it on a luxury vacation. They put that money right back to work, buying more assets. This is how compounding kicks into high gear. Your original investment generates a return, and then that return starts generating its own return. This is the snowball effect that creates massive wealth over time. Sixth, and this is a big one, they buy during times of fear. While everyone else is panicking and selling during a market crash, the wealthy see it as a massive buying opportunity. As the famous investor Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. They know that quality assets are on sale during a downturn. They have their strategy and their cash ready to deploy when blood is in the streets. And finally, number 7, they consistently invest in themselves. They know that their greatest asset is their own knowledge and skills. They spend time and money on books, courses, mentors, and networks that expand their financial education. The more they learn, the better decisions they make, and the more opportunities they can identify. This is the ultimate investment because no one can ever take it away from you. Let me tell you a quick story about 2 friends, Alex and Ben. Both started with the same amount of money. Ben got excited about a revolutionary tech stock everyone was talking about. He put all his money in, dreaming of a quick fortune. The stock soared, then crashed, and Ben lost almost everything. Alex, on the other hand, used his money to learn about index fund investing. He put his capital into a low-cost, diversified fund and just kept adding to it every month, ignoring the daily news. 10 years later, Ben was still looking for the next big thing, while Alex's account had grown steadily into a significant sum, all thanks to his patient, strategic approach. So, how can you start investing like the wealthy? It boils down to a few simple but powerful rules. I call them the 5 wealth rules. Number 1. Pay yourself first. This single habit can change your financial life. Before you pay any bills, before you buy groceries, before you spend on anything else, you take a portion of your income, say 10 or 15%, and you move it directly into your investment account. This automates your investing and makes it a priority, not an afterthought. You're treating your future self as your most important bill. Number 2. Protect your capital. The first rule of investing isn't to make money, it's to not lose money. This doesn't mean you avoid all risk. It means you understand the risks you're taking and you manage them intelligently. You don't invest your emergency fund. You don't take on stupid levels of risk for a small potential gain. Your goal is to stay in the game long enough for compounding to work. Number 3. Think in decades, not days. Get rid of the short-term mindset. When you buy a quality asset, plan to hold it for the long haul. The stock market will have bad years, but over any 10 or 20-year period, it has historically performed very well. Patience is your superpower in investing. Let time do the heavy lifting for you. Number 4. Own assets. Make it your mission to continuously acquire things that will pay you. Shift your focus from consuming to owning. Instead of buying the latest phone, maybe you buy a few shares of the company that makes the phone. Every dollar you direct towards an income-producing asset is a soldier you sending out to fight for your financial freedom. And number 5. Stay patient. This might be the hardest rule of all. Building wealth is a marathon, not a sprint. There will be times when your portfolio goes down. There will be times when it feels like you're not making any progress. This is normal. The people who succeed are the ones who stick to the plan, stay consistent, and trust the process, even when it's boring. The path to wealth isn't a secret. It's a set of principles and habits, available to anyone willing to learn and apply them. It starts with changing your mindset from that of a consumer to that of an investor. Start today. Pay yourself first, focus on assets, and think long-term. Your future self will thank you for it. Thanks for watching. If you found this helpful, give it a like and subscribe for more content on building wealth and financial freedom. See you in the next video.